Hello, I'm your host, a seasoned futures trader with over a decade of experience in financial markets. Now you might be wondering, what are futures? Well, futures are financial contracts obligating the buyer to purchase an asset or the seller to sell an asset at a predetermined future date and price. It's a fascinating world that plays a crucial role in global finance. From commodities like oil and gold to financial instruments like bonds and currencies, futures trading is key to how these markets function. It allows traders and investors to speculate on price movements, hedge against potential risks, and access leveraged positions for potentially higher returns. But it's not all sunshine and rainbows. Futures trading can be complex and carries its own unique risks, which is why it's essential to understand the ins and outs before diving in. Join me in this journey as we uncover the essentials of futures trading. To start off, we need to understand what futures trading is all about. A futures contract is a legal agreement to buy or sell a particular commodity or asset at a predetermined price at a specified time in the future. Unlike stocks, which represent ownership in a company, futures are derived from these assets. Hence, they are known as derivatives. One of the unique features of futures trading is the concept of leverage. Leverage allows traders to control a large amount of the underlying asset with a relatively small amount of capital. However, with this increased buying power comes increased risk, hence the need for margin. A margin is a deposit required to open a position in the market. It acts as collateral to cover any potential losses that may occur. Now that we grasp the basics of futures trading, let's delve into its advantages and potential risks. Futures trading can be a double-edged sword, offering both opportunities and risks. On one hand, futures offer a wealth of benefits. They provide hedging opportunities, allowing traders to protect themselves from adverse price movements. This is especially useful in volatile markets. Furthermore, futures markets are highly liquid, ensuring easy entry and exit. And let's not forget the potential for high returns, thanks to the concept of leverage. But be warned, this sword cuts both ways. The same leverage that can magnify your profits can also amplify your losses. Futures markets are known for their volatility, and price swings can be drastic. This, coupled with the fact that futures contracts have an expiration date, adds an element of time pressure that can be stressful for traders. Remember, the potential for substantial losses is as real as the lure of significant gains. It's crucial to approach futures trading with a clear understanding of these risks. With the right knowledge and caution, you can navigate these risks and capitalize on the opportunities. Ready to get started? Here's how to set up your futures trading account. First, you'll need to choose a reputable brokerage that offers futures trading. Make sure to check out their fees, platform features, and customer service. After selecting your broker, you'll need to open a trading account. This usually involves filling out an application form and providing some identification documents. Once your account is set up, it's time to choose your futures contract. This is a critical step, as futures contracts vary based on the underlying asset, such as commodities, currencies, or indices. It's important to choose a contract that aligns with your trading goals, risk tolerance, and market understanding. Don't rush this process. Spend time understanding the contract specifications, including the contract size, tick size, and expiration date. Also, keep an eye on the market trends of the underlying asset. Remember, thorough research is key when it comes to choosing your futures contract. Let's break down the structure of a futures contract. A futures contract is a legal agreement to buy or sell a particular commodity or financial instrument at a predetermined price at a set time in the future. Each contract has specific details, including the contract size, which is the amount of the commodity or asset that is being traded. Then we have the expiration date, which is when the contract must be fulfilled. And finally, the tick size, which is the smallest price change that can occur in the trading of the contract. Now, onto futures price quotes. These are typically displayed in a table format, showing the contract month, last price, change, open, high, low, and volume. The last price is the most recent price at which the contract traded. The change shows how the last price has moved from the previous day's closing price. Understanding these basics will help you navigate the futures market more effectively. Now let's dive into the world of technical and fundamental analysis. Technical analysis is like a compass, guiding traders through a sea of market data. Its tools and indicators help traders identify trends and make predictions about future price movements. Some of the most useful tools in the futures market include moving averages, which smooth out price data to identify trends over time, the Relative Strength Index, or RSI, which measures the speed and change of price movements, and the Moving Average Convergence Divergence, or MACD, which reveals changes in the strength, direction, momentum, and duration of a trend. On the other hand, fundamental analysis is like a magnifying glass, allowing traders to examine the market's underlying forces. It involves studying economic indicators and news events that can impact prices. These can range from GDP reports to employment figures, inflation rates, and even geopolitical events. Remember, in futures trading, everything from weather patterns to political unrest can impact commodity prices. While technical analysis helps you understand what is happening in the market, fundamental analysis helps you understand why. Both are crucial for making informed trading decisions. Understanding the what and why provides you with a comprehensive view of the market, allowing you to spot opportunities and manage risks effectively. These tools and indicators will help you make informed trading decisions. A solid trading strategy is a crucial part of successful futures trading. It's not just about buying low and selling high. It's about having a systematic approach that guides your trading decisions, managing risks, and optimizing profits. Firstly, you need to determine your entry and exit points. These are the price levels at which you plan to buy or sell a futures contract. Your entry point could be based on a variety of factors, such as a certain price level, a specific technical indicator, or a fundamental event. Your exit point, on the other hand, should be determined by your risk tolerance and profit target. Next, you need to decide on your position size. This refers to the number of contracts you trade in each position. This is where risk management comes into play. You should never risk more than a small percentage of your trading capital on any single trade. Once you've outlined your strategy, it's time to put it to the test. This is where backtesting comes in. Backtesting involves applying your strategy to historical data to see how it would have performed. It helps you fine-tune your strategy, identify its strengths and weaknesses, and increase your confidence in it. However, the markets are always changing, and what worked in the past may not work in the future. Therefore, it's essential to continually monitor your strategy's performance and make adjustments as needed. Remember, a successful trader is always flexible and ready to adapt. You've done your research, developed a strategy, now it's time to place a trade. We begin this process by logging into our trading platform. Here, the world of futures contracts is at our fingertips, ready for us to dive in. To place a trade, we first select our chosen contract from the market watch list. Next, we decide on our position size, taking into account our risk tolerance and the specifics of the contract. With our position size set, we proceed to enter our order. This is where we set our stop loss and take profit levels. These levels are crucial in managing our potential losses and gains. A stop loss order automatically closes our position if the market moves against us, limiting our losses. On the other hand, a take profit order ensures we lock in our gains when the market moves in our favor. Remember, trading is not just about making profits, it's also about managing losses. Futures trading is as much a test of your psychology as it is of your strategy. Risk management is a critical aspect of trading. It involves setting stop-loss orders to limit potential losses and managing risk per trade to ensure sustainability in the long run. Always remember, in trading, it's not about how much you win, but how much you don't lose. Now, let's touch on trading psychology. It's crucial to maintain discipline and patience in this game. Sometimes the best trade is the one you don't make. It's easy to get caught up in the excitement and make impulsive decisions. But that's where you need to step back and stick to your strategy. Emotion management is another key factor. Whether it's greed, fear, or overconfidence, emotions can cloud your judgment. Make your decisions based on logic and strategy, not emotions. Trading is a marathon, not a sprint. Patience and discipline will be your greatest allies.